92%. That is the share of Indonesian workers who say they use AI tools at work, the highest rate of any country in the world. And at the same time, Indonesia faces a projected shortfall of 9 million digitally skilled workers by 2030. The country with the world's highest AI adoption rate cannot fill the jobs that AI adoption creates. That paradox is the entry point into the most interesting digital economy story in Southeast Asia right now.
Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Alex, Indonesia keeps showing up in the data in surprising ways. Set the scene for us. What is actually happening on the ground?
So, the macro context first. Indonesia's digital economy crossed $100 billion in 2025, which makes it the largest digital economy in Southeast Asia, surpassing even Malaysia and Singapore combined. The government target is $600 billion by 2030. That is a six-fold increase in 5 years, which is an extraordinarily ambitious number. For comparison, India's digital economy is currently estimated at around $300 billion. So Indonesia is essentially betting it can reach twice India's current digital scale in 5 years, starting from $100 billion.
What is driving the investment interest from global players?
3 things. First, the scale of the domestic market. Indonesia has 270 million people, a young demographic profile, and a mobile-first consumer base. When you look at e-commerce penetration, fintech adoption, and social commerce, Indonesia already operates at a level of digital maturity that surprised most analysts 5 years ago. Second, the geopolitical moment. As companies diversify supply chains and data infrastructure away from China, Indonesia is a natural destination, large domestic market, relatively stable government, and not entangled in the Taiwan Strait risk calculations that dominate enterprise decisions about where to put sensitive workloads. Third, the AI infrastructure wave. Every hyperscaler needs to build in-country to meet data residency requirements, and Indonesia has those requirements. So you get Microsoft, Google, Amazon, and now specialist data center operators all competing to put capacity in Jakarta.
Walk us through the investment numbers because they are significant.
Microsoft announced $1.7 billion in Indonesia in April 2024. That is the largest single investment Microsoft has made in Indonesia in its 29-year history in the country. In May 2025, they opened the Indonesia Central Cloud region, which is their first full in-country region with data residency guarantees. Microsoft also committed to upskilling 840,000 Indonesians in AI and cloud skills. The IDC modeling suggests the Microsoft ecosystem alone will contribute $152 billion to the Indonesian economy between 2025 and 2028 and support more than 106,000 jobs.
And Google?
Google has had a Jakarta cloud region since 2020, which was actually their first independent domestic region in Asia-Pacific. They expanded AI-ready data center capacity again in May 2025, and the economic contribution modeling PwC did for Google suggests their presence has supported about 92,000 jobs annually over the past 5 years. The forward projection for the next 5 years is 240,000 jobs annually.
Those are enormous numbers for a single company's local presence.
They are. And the third major data point is Princeton Digital Group, which is not a hyperscaler but a specialist data center developer. They broke ground in Greater Jakarta on a $1 billion, 120-megawatt AI-ready hyperscale campus. Phase 1 is targeted for Q4 2026, and that is just one project. The broader Jakarta market is tracking toward roughly 250 megawatts of wholesale and co-location capacity across multiple projects.
So the infrastructure investment thesis is real. Where does the complexity start?
The complexity starts when you map the investment story against the policy story. Prabowo Subianto took office in October 2024 with a strong rhetorical commitment to digital and AI development. His administration published an AI National Roadmap white paper in July 2025, issued Presidential Decree 83 in August 2025 directing AI deployment in public services with a target of 400 billion rupiah in bureaucratic cost savings, and announced plans for AI governance regulation in early 2026. The language is forward-leaning, and the institutional infrastructure is being built.
But
the 2026 government budget does not include digitalization or AI as an independent budget priority line. The actual spending priorities are food security, energy security, the free school meals program which Prabowo campaigned on, education, and defense. AI infrastructure appears in policy documents. It does not appear in budget allocations in a way that matches the rhetoric.
that gap between the policy ambition and the fiscal reality is a classic emerging market tension.
And it shapes the investment dynamics significantly. What it means in practice is that Indonesia's digital build-out is going to be driven by private sector and foreign direct investment, not by government spending, which is fine. That's largely how it has worked in Singapore and to some extent in Malaysia. But it also means the government's ability to direct the build-out towards strategic national priorities rather than pure commercial logic is more limited than the roadmap implies.
Let's get into the super app story, because Grab and GoTo have been circling a potential merger for years, and it finally seems to be going somewhere. Or maybe not going somewhere at all.
The Grab-GoTo situation is genuinely one of the most interesting corporate governance and antitrust stories in Southeast Asia right now. Let me give the background first.
So Grab and GoTo are the two dominant super apps in Southeast Asia. Grab is Singapore headquartered, operates across 8 ASEAN countries, and is listed on NASDAQ. GoTo is Indonesia headquartered, listed on the Jakarta Stock Exchange, and is the combination of Gojek, the ride-hailing and delivery platform, and Tokopedia, Indonesia's largest e-commerce platform. A merger between them would create something genuinely unprecedented, a single platform with dominant market positions in ride-hailing, food delivery, e-commerce, digital payments, and financial services across the largest market in Southeast Asia.
And the deal has been rumored for years. What happened most recently?
In January 2026, Bloomberg reported that the merger talks had hit a significant snag. The obstacle is not regulatory approval, though that is a separate issue. It is specifically Telkomsel, Indonesia's state-backed telecommunications company, which holds approximately 2% of GoTo's outstanding shares. The problem is that Telkomsel invested in GoTo at a much higher price than where GoTo stock currently trades. At current market prices, Telkomsel would realize a significant loss on that stake if it accepted the merger consideration, and Telkomsel has indicated it is not willing to accept terms that crystallize that loss.
So a 2% shareholder is blocking a multi-billion-dollar deal?
It is more nuanced than that. Telkomsel is state-backed, which means it is not a purely commercial actor. There are political considerations around whether the Indonesian government wants to be seen as the entity that blocked a major consolidation in Indonesia's digital economy versus the entity that facilitated it. The Indonesian Competition Commission, called KPPU, has also issued what analysts described as the strongest possible warning language about the merger, saying it has the authority to void any combination that damages competition. In a combined Grab-GoTo entity, the market concentration numbers are extraordinary. Ride-hailing would go above 90%. Digital payments and food delivery would go above 85%. KPPU has real legal authority to block that.
And where does Danantara fit in? Because I have been hearing that name in this context.
Danantara is Indonesia's new sovereign wealth fund, established under Prabowo to consolidate state-owned enterprise assets. One of the structural solutions being discussed is Danantara acquiring a golden share in the merged entity, a special class of shares that gives the Indonesian government specific veto rights over strategic decisions, particularly around data, security, and foreign ownership. If that structure works, it potentially addresses 3 concerns simultaneously: Telkomsel's loss crystallization problem by restructuring how the transaction is priced, the KPPU's concentration concern by inserting a national interest override mechanism, and the Indonesian government's broader concern about a foreign headquartered company, Grab is Singapore-based, controlling the dominant digital infrastructure of Southeast Asia's largest economy.
That is a complicated 3-dimensional chess problem.
It genuinely is, and the financial trajectory of both companies adds urgency to finding a resolution. Grab's revenue guidance for 2025 is $3.3 to $3.4 billion, up 19 to 22% year over year. Their adjusted EBITDA guidance is $490 to $500 million, which represents 40 to 50% growth. Grab is profitable, growing, and its unit economics are improving. GoTo is a different story, still loss-making, but the rate of loss is shrinking fast. In the first 9 months of 2025, GoTo's net loss was approximately 1 trillion rupiah, roughly $60 million, compared to 4.5 trillion rupiah in the same period the previous year. So the losses are still real, but narrowing dramatically as GoTo pivots towards its Indonesia domestic fintech focus.
Let me shift to the data center competition question, because you mentioned Jakarta versus Johor Bahru earlier. How should people think about those two markets in relation to each other?
The comparison is instructive. Johor Bahru, on the Malaysian side of the causeway from Singapore, is by any quantitative measure the dominant data center market in Southeast Asia right now. 487 megawatts of operational capacity, growing to over 1 gigawatt by end of 2026, with committed projects extending to over 4 gigawatts further out. The growth rate is extraordinary. They added 160 megawatts in the first half of 2025 alone. The drivers are well understood: proximity to Singapore, dramatically lower land and electricity costs, and active government incentivization.
So where does Jakarta fit in that picture?
Jakarta's pitch is different. It is a domestic demand story rather than a Singapore spillover story. The companies building in Jakarta, Microsoft, Google, AWS, Princeton Digital Group, are primarily doing it to serve the Indonesian domestic market with data residency compliance, sub-20 millisecond latency, and local sovereign cloud offerings. The workloads that end up in Jakarta are different from the workloads in Johor. Johor captures the international hyperscale compute that wants Singapore proximity at lower cost. Jakarta captures the Indonesian government workloads, the compliance-sensitive financial services deployments, and the consumer internet companies serving 270 million Indonesians who need local infrastructure for performance and regulatory reasons.
So they are not really competing for the same workloads.
Not primarily, no. The more accurate frame is that Johor and Jakarta together are building the data infrastructure layer for the ASEAN digital economy, with different nodes serving different purposes. The risk for Indonesia is if the non-sovereign workloads, the things that don't strictly require Indonesian data residency, increasingly land in Johor instead of Jakarta, because the cost differential is significant enough to override any other consideration. That's worth watching over the next 2 to 3 years.
Let's talk about the e-commerce layer, because the TikTok Tokopedia story has been fascinating.
The TikTok-Tokopedia combination is one of the most consequential structural shifts in Indonesian e-commerce in years. In December 2023, TikTok invested $1.5 billion in Tokopedia, GoTo's e-commerce subsidiary, to form a joint venture for social commerce. Within 18 months, the TikTok Shop plus Tokopedia combination had captured between 35 and 40% of Indonesia's e-commerce market, with gross merchandise value exceeding $20 billion. For context, TikTok Shop Indonesia alone had GMV of $6.2 billion in 2024, making it TikTok's second largest e-commerce market globally after China.
That is extraordinary growth.
And the live commerce dimension is important. Video-driven GMV in Indonesian e-commerce went from under 5% in 2022 to approximately 20% in 2025. This is not a niche format anymore. It's reshaping how Indonesian consumers discover and purchase products, and it's creating a structural challenge for traditional e-commerce platforms like Shopee, which still leads with 43% market share, that built their discovery and conversion model around search and browsing rather than video and live streaming.
Contrarian corner time. Because the consensus view on Indonesia is genuinely exciting. Largest digital economy in Southeast Asia, world's highest AI adoption rate, big tech pouring in capital, and a $600 billion digital economy target. What is the case against the bull narrative?
The bear case starts with a question about what AI adoption at 92% actually means. Because when I look at that number carefully, it is a survey-based measure of workers who say they use AI tools at work. And in Indonesia's context, that includes a very wide range of behaviors. Using a WhatsApp AI feature, using Google Translate, using a basic recommendation algorithm and an e-commerce app. All of those might qualify under the survey methodology. So the 92% figure tells you something real about digital tool adoption in Indonesia, but it probably overstates the sophistication of AI deployment relative to what you would find in, say, Singapore or South Korea.
So the headline number is misleading.
The headline number is directionally real. Indonesians are genuinely digitally engaged and technology forward in ways that are impressive for a lower middle-income economy. But the specific implication that Indonesia is at the frontier of AI deployment in a business productivity sense is probably overstated, and the 9 million person digital skills gap by 2030 is the more reliable indicator of where the economy actually is.
There is also the $600 billion target question. Walk me through why you are skeptical.
The math is not impossible, but it requires a set of conditions to hold simultaneously that are historically unusual. Going from 100 billion to 600 billion in 5 years is a 6-fold increase. For comparison, Indonesia's digital economy went from $11 billion in 2019 to 100 billion in 2025, roughly a 9-fold increase in 6 years. But that was off a much smaller base and benefited from the extraordinary pandemic-driven acceleration of digital adoption that is probably not repeatable. The growth from here requires sustaining 25 to 30% compound annual growth in an economy that is also dealing with commodity price volatility, fiscal consolidation pressures from Prabowo's social spending commitments, and a global environment where U.S.-China tension creates uncertainty about export markets.
And the budget priority gap you mentioned earlier is relevant here.
Directly relevant. The government's own budget allocation priorities in 2026, food, energy, meals program, education, defense, are not wrong priorities for a country at Indonesia's income level, but they signal that the digital economy build-out is going to be funded and driven primarily by the private sector and foreign investors, which means it will be shaped by commercial logic rather than by a coherent industrial policy. That is not necessarily bad, but it means the $600 billion number is a market forecast more than a government commitment.
There is also the Grab-GoTo question. If that merger does go through, you end up with an incredibly concentrated digital market. Is that good or bad for Indonesia?
There are genuinely two ways to interpret this. The bull case for the merger is efficiency. A combined entity would have the scale to invest much more aggressively in financial inclusion, getting digital payments and credit to the unbanked and underbanked Indonesians who currently operate in cash, and the combined R&D budget would allow faster AI integration across services. The bear case is that 90% market concentration in ride-hailing and 85% in payments creates pricing power that will be used against consumers and merchants once the competitive pressure is eliminated.
The KPPU's warning suggests they are leaning toward the bear case.
Which is interesting because KPPU is generally considered a less aggressive antitrust authority than, say, the EU Competition Commission or the FTC. For them to issue the language they issued, specifically saying they have the authority to void the deal post-completion, is a signal that Indonesian regulators have genuinely internalized the monopoly risk. What happens to the Danantara golden share proposal in that context is unclear. Does the government's golden share mechanism satisfy KPPU that national interest oversight substitutes for competition? Or does KPPU view that as regulatory theater that does not address the actual competitive harm to Indonesian consumers?
I want to push on the Jakarta versus Johor narrative a bit more, because I think there is a version of this where Indonesia ends up with prestige data center investments, and the Singapore-Johor corridor captures most of the actual AI compute work.
That is the sharpest version of the concern, and it is not hypothetical. It is already partially happening. The workloads that do not have strict Indonesian data residency requirements are going to optimize for cost, and Johor has a significant cost advantage. The risk is that Indonesia's investment in digital sovereignty infrastructure ends up serving compliance requirements, but not capturing the high-value AI training and inference workloads that will define which economies have structural advantages in the AI era.
So Indonesia could build impressive-looking data center capacity without building the AI capability that actually matters economically.
That is the risk. The saving grace is that Indonesia's domestic market is so large that even domestically constrained infrastructure investment creates real economic value. A cloud region serving 270 million Indonesian consumers with local latency is genuinely valuable regardless of whether it also captures export-oriented AI compute. The question is whether Indonesia is satisfied with being the largest domestic digital market in Southeast Asia, or whether it wants to be a regional AI infrastructure hub. Those are different ambitions requiring different strategies, and right now Indonesia's public statements suggest the second ambition, but its budget allocations suggest the first.
And the skills gap is the thread connecting all of this. Because whether you are talking about filling data center operations roles, building fintech products, or implementing AI in government services, the binding constraint is the same.
The 9 million person shortfall by 2030. And this is where the Microsoft commitment to upskill 840,000 Indonesians is interesting, not just as a number, but as a model. If the training pipeline for Indonesian AI talent is primarily funded and delivered by the same hyperscalers building the infrastructure, those workers will be trained on Microsoft Azure, Google Cloud, and AWS, which is fine from a skills perspective. But it means the talent pipeline is architected by the infrastructure vendors rather than by an Indonesian national education and workforce strategy.
Action items. What should investors and operators watching Indonesia actually track?
3 action items. First, watch the Danantara golden share proposal as the bellwether for how Indonesia handles the tension between national digital sovereignty and foreign capital. The Grab-GoTo merger is one test case, but the broader question is whether Indonesia can design a governance structure that attracts the scale of foreign investment it needs while maintaining meaningful national oversight of strategic digital infrastructure. Danantara is Prabowo's vehicle for that ambition. It is essentially Indonesia's attempt to do what Temasek does for Singapore, but for a much more complex and politically contentious set of assets. If the Danantara golden share mechanism works for the Grab-GoTo situation, it becomes a template that will be applied to future foreign investments in Indonesian digital infrastructure. If it fails, or if it is perceived as regulatory theater by the Competition Commission, it signals that Indonesia has not yet found its model for sovereign digital governance.
The second action item?
Track the government workload migration to Indonesian domestic cloud regions over 2026 and 2027. Prabowo's Presidential Decree 83 mandated AI in public services with a bureaucratic efficiency target. The question is not whether that decree exists, it does, but whether the actual migration of government workloads to domestic cloud happens on the declared timeline. Government cloud migration in emerging markets is almost always slower than announced, but the pace of that migration is the best leading indicator of whether Indonesia's data sovereignty requirements will create sustainable demand for the Jakarta data center build-out, or whether the market will remain primarily driven by private sector commercial demand that is more susceptible to cost arbitrage with Johor.
Third,
watch TikTok Shop's expansion beyond Indonesia into the broader Southeast Asia region and whether the Tokopedia partnership becomes the template. The TikTok-Tokopedia joint venture is the most interesting structural experiment in ASEAN commerce right now. If live commerce capturing 20% of Indonesian GMV in 2 years translates to similar penetration in Vietnam, Thailand, and the Philippines, you have a fundamental restructuring of how retail discovery works across the region. The incumbents, Shopee, Lazada, and the traditional retail chains, are watching this closely and have not yet figured out a successful response. That dynamic is worth tracking specifically in the Vietnamese and Thai markets, where the next inflection points are likely to occur over the next 12 to 18 months.
So the three signals are Danantara golden share as a sovereign governance test, government cloud migration pace as a demand signal for Jakarta infrastructure, and TikTok Tokopedia as a live commerce expansion template. Those are all watching the same underlying question from different angles. Is Indonesia's digital build-out driven by genuinely sovereign industrial policy or primarily by foreign capital following commercial logic?
That is exactly the frame. And I want to be honest that I don't have strong conviction on which way it resolves. The bull case, Indonesia successfully leverages foreign capital to build genuine domestic digital capability, is historically unusual but not impossible. Singapore did something close to it, though Singapore had very different institutional starting conditions. The bear case, Indonesia builds impressive-looking digital infrastructure that is effectively operated by foreign hyperscalers and super apps with limited domestic capability transfer, is more consistent with the historical pattern in other digital economy catch-up stories.
The $600 billion digital economy target is doing a lot of work in the bull case narrative.
It is, and that number is worth watching not as a forecast but as a policy commitment signal. If Indonesia's 2027 and 2028 budget cycles start including specific line items for domestic AI capability building beyond the rhetorical roadmap and the hyperscaler upskilling commitments, that would be evidence that the government has bridged the gap between ambition and fiscal allocation. If those budget cycles continue to prioritize food, energy, and social spending with digital as a private sector story, the $600 billion number is probably aspirational rather than structural. That distinction matters enormously for how you think about the risk profile of exposure to Indonesian digital assets.
In our next episode, we are turning to Vietnam, specifically how the country is navigating its post-tariff deal moment, whether the FDI diversification story is creating genuine domestic semiconductor and electronics capability or just final assembly operations, and what the first AI law in Southeast Asia actually means for how companies operate there.
Stay data-driven. Bye.